All right, good afternoon. Hope everyone is doing well today. Thank you for joining us. I hope you're having a great start to the new year. And so this is the first presentation we've done this year. And I think we've got a lot of people wondering what our thoughts are, as well as not as many people realize there were some pretty significant changes to some retirement accounts and some of the rules around that. So we're going to cover that today too. For those who don't know, my name is Nick Murphy with Counterweight Private Wealth. Before we get started, I want to just real quickly draw your attention to our website. And the only reason I say that is I encourage you to stay connected. One of the things that we do on this Insights tab is we are regularly posting some commentary, some of our thoughts, some articles, etc., that I think might be important. So I would encourage you to check that out from time to time. And then also, not many of you realize we do have, if you're on social media, I encourage you to follow us, because when we write a new article, we'll release that on social media. We're posting various different things. And so it's a great way to stay connected and hopefully find some relevant information. And we also have a YouTube channel, which there's some videos on here I encourage you to possibly check out, because I want you to be able to stay connected as possible. All right, so without further ado, I've broken this into two main sections. I'm going to forewarn you and apologize in the beginning here that this may run longer than 30 minutes. I'm going to try to really condense it best we can, but there are some things I think that are very important to go over. All right, so let's start with, first of all, I'm going to try to get this to work. There we go. One thing is important to know. This is a disclaimer. Any forward-looking statements we make are just our best guess. No one knows. We're not making any sort of guarantees. Whatever we think the market is likely to do, who really knows? That's the bottom line. So please consult, if you're not a client of ours, consult with your own advisor, consult with a tax advisor if needed on any particular concepts that are addressed. And feel free to read that at your leisure. All right, so here's the bad news. Bad news that you already know is that it was a bad year last year. It was rough. There was a lot going on. If you've read the things that we've been putting out, I'm not going to go into the reasons why we had a difficult year. It's primarily due to inflation, and then the response by the Federal Reserve raising interest rates, really putting a clamp on a lot of equity prices. And you may have heard the term "don't fight the Fed." That's a term in the investment world. And really what it means is when the Federal Reserve is either being more accommodating and increasing the money supply, or less accommodating and removing the money supply, don't try to fight against what they're doing with your investment portfolio. And that reigned to be true in 2022 as well. So the S&P 500 total return was down a little over 18%. The NASDAQ, which is a lot more technology heavy, was down 32.5% for the year. The international markets were down 14%, so actually a little bit better than US markets. The real estate index down 28% last year. And maybe you could hide out in bonds. Well, unfortunately, bonds had one of their worst years on record as well. There really was no place to hide. Bonds took a real beating because interest rates went up. And a lot of people forget the fact that bonds are subject to interest rate risk. And so as interest rates rise, bonds can and will fall in value. In fact, the US Treasury, I think, was down 18% last year. So difficult year. So where does that leave us going forward? Well, first, let me show, how does 2022 compare historically? And so I've identified right there is I think one of the worst 12 years since 1928. So that even predates the Great Depression. It was a pretty difficult year historically. And so that's important I always want to remind us of a historical framework, because while things might be different and situations and conditions are different, history really is the best guide that we can use to try to identify what might happen in the future. So there we are. And I'm going to revert back to this chart here in a second, because I think it does help with some historical framework. So flipping into 2023, what do we expect? What does the market expect? What do the experts say? So these are the kind of the top firms on Wall Street's expectations for 2023. Now, we started the year at the S&P 500 with a level of 3840. So that was our starting point. And so most of the experts, as you can see here, expect kind of a flat to maybe up a little bit year. There's a few that expect that maybe the market will continue to go down further in 2023. And then there's a few outliers that feel that the market might actually do pretty well. I always like looking at this. And in fact, I went back and I looked at last year's predictions. And as you would probably expect, it was a little bit off all over the place. And a lot of people, I mean, almost everybody expected the market to go higher. And I have said, I think I wrote it in a blog post, that I don't really find the practice of trying to identify what a year-end target, I don't find that very effective, because who knows? And what I'm about to show you in a minute is that market returns are going to be volatile. And there's rarely a time when the market just kind of goes up 8% in a year. So that being said, let's look back at this chart. Okay. Why is it not? There we go. So let's look back at this chart real quick. The thing that I'll point your attention to. So of these, this is 95 years of calendar returns. And the 0 to 10% return, so that would be, maybe flat to moderate. It's a very small segment of the returns. And so even though the S&P 500 has returned approximately 10% average annual return for the last 95 years, that doesn't happen in those increments very much. In fact, if you looked at, say, if I said, I think it's going to be somewhere between 8 to 10% this year, well, how many of those intervals was it between 8 and 10%? One. All right. Between 8 to 12%. Okay. 1, 2, 3, 4 times out of the last 95 years. The point being is this. When you hear experts predict, hey, the market, we think our year-end target is X. And when you do the math, that ends up being, maybe it's 3%, maybe it's 5%. It's rare occasions that the market's actually going to move in those small increments. The market will be volatile. It will be moving around substantially. But you're never going to hear an expert say, well, I think the market's going to be up 35% this year or down 28%. It's not likely to happen. So what I think is most important, let's focus on direction, whether we think the market is, going to be going higher and start moving in that direction long term, or do we have some more pain ahead? So moving on, those who know me, you know that I like to look at sentiment. Sentiment's just a measure of how people are feeling. And so I've shown you the American Association of Institutional Investors sentiment before. But here's a couple other sentiment indicators that I think are quite interesting. This is a Bank of America Global Fund Manager survey asking what level of risk do you think you're currently taking in your investments? And if you look at, if you look here, okay, these were some high points where investors felt they were taking large risks. But look at where we are today. The only time it has been lower, actually we're even lower than 2009, okay? So investors, by and large, are positioned very, very conservatively and very defensively, okay? Let's look at another measure. what percentage of investors say that they are overweight US stocks? And we look here again, and the large majority of investors are very underweight or underinvested in US stocks. Okay. Two measures that are showing that positioning is pretty bearish, or people are pretty negative at the moment. All right. So let's frame the discussion from a standpoint of history. So if you go back to this chart again, we see that returns are all over the place in a calendar year. So historically, what tends to happen after a negative year? Well, this chart reflects the annual returns for the last almost 75 years, since 1950. There have been 19 negative years in the S&P 500 since 1950. And so what happened after those negative years? What did the market do? So it's interesting. 84% of the time, the market has been positive the following year. And what's really remarkable is that over half the time, 53% of the time, the returns in the stock market after a negative year have been greater than 20%. Okay, it's another little historical anecdote to add to the picture here. Well, but as we all know, this might be a different period of time. And one of the comments that I hear is, hey, you list all the concerns, we've all heard them, high level of national debt, inflation out of control, et cetera. Well, there is a little bit of historical framework. Now, nothing's identical. History, again, doesn't repeat, but it rhymes. If you think back to the 70s, we had very high inflation, very high interest rates. And in 1980 to 82, then Fed Chairman Paul Volcker essentially said, enough's enough, we're clamping down, we're going to shut this inflation down, even if it means we send the economy over a cliff. It's basically what they did. So back in 1980, okay, through some very, very aggressive interest rate hikes and tightening to try to combat really what was a decades-long inflationary cycle, the S&P 500 during that period dropped 27% from peak to trough. Okay? Ouch. We have a very interestingly similar period of time, whereas early 2022, Fed Chairman Powell says, hey, enough is enough. We got to get this inflation under control. Very aggressive interest rate hikes. The market in 2022 from peak to trough was down at one point 25%. Very similar. The one thing I think that is unique about this period of time versus the 1980 period is that period of time, the Fed was combating a very long history of inflation. Really, we saw this transitory spike. A year ago, the inflation number was reading pretty low. It was this huge glut of money and the whole stimulus of the pandemic era that spiked inflation. Well, now we're starting, we've seen that come down. I'll show that in a second. So it's eerily familiar. It's remarkably familiar, in my opinion, where the stock market responded to aggressive Fed policy, just like we've seen this past year. So the next question you're asking, I know, is, well, what happened in 1980? Conventionalism today is that the market may kind of grind higher, that earnings are going to suffer, we may go into recession, et cetera. those are all the concerns in 1980 as well. But what happened is remarkable. So in 1982, the market bottomed, importantly, before Volcker and the Fed pivoted and say, all right, we're going to stop the interest rate hikes. The market bottomed before that. Within 4 months of the market bottom, the whole downturn of the S&P 500 was recouped. You can see how aggressively the market shot up. And within, once Volcker said, hey, we're going to consider kind of ending this war on inflation, within a month, new highs in the market. That's pretty remarkable. And now, next question you're probably saying is, all right, Nick, is that, you really think the markets are going to, go up 30% or something? I'm not necessarily saying that. But what I'm saying is, if you look at investor positioning, which is very negative, if you took a poll, and I watch the same things you watch, and I hear the same things you hear, everybody is banking on a recession, that it's going to be a pretty tough market, maybe for a while, and that the Fed, they're going to throw us into recession. That means that everyone's pretty negative, and it shows in their investor positioning. So it's entirely possible that things might be a lot better than people expect. So what is, our view? Our view is this. Number one, inflation likely peaked in 2022. So back in July, you can go to the website and read the article kind of where I listed what I felt was the reasons inflation had peaked. There's the CPI number. There was the June CPI inflation top. It's been coming down ever since. I think it's going to continue to come down, which is going to leave the Federal Reserve with less reason to have to be very aggressive. Okay. Two, this is not conventional wisdom, but I think it's very likely that October of 2022, right, where peak to trough, we were down a little over 25%. I can see that was probably the lows of the bear market. Doesn't necessarily mean we take off from here, but I just don't see why there would be huge further downside ahead. Okay. The other thing that's very, very interesting, and again, if you followed any of our commentary or know me at all, trends are important. Okay. Ultimately, fundamentals are what determines the price of any stock or the economic growth, et cetera. But it's important to take a look at what trends are doing, because that's how investors are actually being positioned. They're voting with their money. We had a very, very long downtrend, very orderly. I mean, it was to a T. This trend line, that was all of last year. That's the peak of early 2022, January. Okay, and then we had a rally back in late March, another decline, a rally back. There's the October lows, rally back in December. But look at what's happening recently. And by recently, I really mean like the last couple weeks. We have broken through this downtrend. That in and of itself doesn't say, hey, the coast is clear, and doesn't necessarily mean we're just marching up. But it is something I think to pay attention to. And what's happening is the market is climbing higher in the face of worry and concern. And there's an old saying on Wall Street that bull markets climb a wall of worry. And I think that's exactly what's happening now. You hear negative news, earnings are coming out, guidance is lower, market goes higher. It doesn't make a lot of sense. It won't make sense until after the fact, and you look back and the market's already moved 15%. That's just how markets work. Okay? So I do think we're breaking the trend, which leads me also to give credence to the possibility that this could be a good year. Okay? I feel that the economy been very resilient. Earnings have been largely better than expected. There was some numbers out by the IMF today talking about how they don't feel there's going to be a recession, actually increase their GDP forecast. I mean, there's resilience in the economy. I don't think we hit a recession. If we do, I think it'll be mild and short. The bond market is something to pay attention to, where rates are and looking at the yield curve. The bond market right now is fighting a war against the Fed. It's predicting. The Federal Reserve has been positioning and speaking and telling you, hey, this is what we plan to do. The bond market is saying, no, you're going to pivot. You're wrong. And historically, the bond market has had a pretty good level of success in predicting outcomes. That's another thing that kind of goes into this little decision-making tree, is that the bond market is telling you that the Fed is likely to maybe pause or pivot before maybe they've suggested they will. And then, as I mentioned within kind of some of those investor sentiment numbers, based upon how investors are positioned, I can easily see how a lot of people are going to get caught flat-footed if we do start to get a pretty good market, which that usually happens after market bottoms. No one believes the bottom is in until way after the fact, and you look back. So I think you can make a case that equities, stocks this year could be a pretty good year. What does that mean? Are we going to hit this target? That I don't know. But I do think that you don't want to be very, very, very defensive and conservatively positioned now if you're a long-term investor. Okay. Remember, again, you've got to link your investments to your goals. And so that's the first thing. But if your goals and your investments tell you need to have a certain exposure to stocks for growth, now's not the time to undervalue that. Now's the time that you want to be invested, given your risk parameters, into stocks. All right. All right. Now, what am I? All right, it's 20 minutes. Not bad. So let's discuss real quickly before I jump into the Secure Act, some updates on retirement plan limits. This is important. Beginning of every year, you should reevaluate. Again, if you're trying to hit your maximum 401k deferrals and such, here's the updated numbers. So this year, employees can contribute up to $22,500 into their 401k or 403b, et cetera. That increased by $2,000. The catch-up contribution, if you're 50 or older, if you turn 50 this year, make sure you bump up the catch-up. You get another $7,500. So someone who's 50 or older can contribute up to $30,000 this year into their 401k, Roth 401k, et cetera. In addition, traditional IRA and Roth IRA contribution limits have gone up. Now it's $6,500, and if you're over 50, it's $7,500. Remember, you got to have earned income, and there's phase outs. If you make too much money, you can't contribute to a Roth IRA. Okay, more to come on that later. Health savings accounts have increased. A quick little aside, I plan to write an article at some point on health savings accounts. I feel they're one of the most underutilized retirement vehicles offered today. Incredible advantages with health savings accounts. And if you have one, great. If you don't, maybe let's talk about considering it. If you have one and you're not investing the funds, let's talk about that, because you're missing out on some huge, it's triple tax exempt. You get a tax deduction for what you put in, it grows tax-free, and it's taken out tax-free if used for healthcare. And that's a pretty big no-brainer, so you want to grow that as much as possible. The estate exemptions go up a little bit this year. This is important only because at the end of 2025, it's highly likely, as the laws are written right now, that all of these income tax, estate tax laws are going to sunset and go away. And not a lot of people realize this. So come January 1st, 2026, we're going to revert back to what the old tax code was prior to 2016, unless Congress extends something, or, which let's all hold out hope that they'll do anything. But it's entirely likely that if you have an estate that's in some of these ranges, and we haven't talked about it, we really need to talk about if there's some things you might want to do the next couple of years in preparation for potentially that going back to much, much lower estate exemption amounts. All right, so the Secure Act, which I don't know, I mean, it's not the best name in my opinion, but they have to come up with an acronym for every, congressional legislation. So that's what we got, the Secure Act. Before we get into the new updates, just a quick reminder, the original Secure Act was passed, I think, the end of 2019, and they went into effect in 2020. Some of the most notable things in the Secure Act was it raised the age of required distributions to age 72. So required distributions, again, are the money you have in your 401k, IRA, SEP IRA, whatever it might be, that is not Roth. At age 72, whether you need the money or not, you have to start taking distributions, and you're taxed on the amounts that come out according to IRS rules. It used to be age 70 and a half. Then in 2019, they raised that required age to 72. It changed again, I'll cover in a minute. And then the Secure Act in 2019 also introduced a 10-year distribution period for inherited IRAs. So if you inherit, and it's not your spouse that you inherit it from, generally you've got a 10-year window to get the money out. And there's some ambiguity around exactly what the rule is, and that hopefully was going to be cleared up, and we'll discuss that in a minute. If you have inherited an IRA from, say, your parents, it's probably good. Make sure we're aware of it. We can help you through the distribution. There's a lot actually that goes on, believe it or not, particularly if it's of any size, just to try to manage the tax impact. And there's some planning strategies we can do around that we've done for probably a number of you on the call, but please let us know that, because that's important. All right, so the new Secure Act 2.0, signed into law December 29th. That's why not a lot of people even realize, because everyone's busy with their holiday gatherings and turkey and New Year's. And so it kind of went through. There's a little blip on the news about it, but it does have a few pretty major impacts that we're going to discuss. The first one is it does change that required distribution age. So instead of 72, starting in 2023, that required age is 73. Okay. What it means is if you've already started required distributions, nothing changes for you, because you were 72 last year and now you're 73. There's no change. But really just projecting forward, people who are younger than that age, that is your starting point now. In addition, they also forecasted another increase in that age to age 75. So the way it works is, if you are currently taking distributions, there's no impact to you, as I said. If you were born between 1951 and 1959, your required minimum age is age 73. If you were born 1960 or later, your required minimum age is age 75. Okay? So that's just, it was actually written in a much more difficult way to understand. So thanks to Steve for putting that together. That's a whole lot easier to understand when you link it to the birth date. So important things. We're running into this constantly, where people save substantial amounts of money into their retirement account while they work. And then they maybe don't need to take that money for a period of time in retirement. They either have other sources of income, or they work longer than they expect, et cetera. And now they're taking huge distributions at their required minimum distribution age. I really encourage you, for those of you that are clients, we're working through this based upon your age. If you're not a client, I encourage you really need to go through some thoughtful tax planning on how that's going to impact you, because you might be surprised at the impact it will have, particularly on your taxes. One of the easy things to do is consider doing some Roth conversions strategically in certain years, low income years, et cetera. That's a whole nother conversation that we can have a different day. All right, some other highlights of the Secure 2.0 Act. This is unique and interesting. So now the employer matching contributions in your 401k. So you have a traditional 401k, you also have the ability to do a Roth 401k. But up until now, regardless of which one you contributed into, if your employer matches your contributions, that always went into the traditional 401k. There were always pre-tax dollars. Now, starting this year, it's possible, if your employer permits this and changes their plan, that the matching contributions that they do can also be Roth. So if you're contributing to the Roth and you want your matching contributions to be Roth, the Secure Act now allows that can happen. In actuality, what's probably going to happen is it's going to take a little time for administrators and employers to build out the mechanisms to be able to do that and allow it, but it is live today. So feel free to ask your employer about that if that's something you want to do. Another unique change in the Secure Act is that starting next year in 2024, if you are making catch-up contributions, so you're 50 or older, and you earn more than if your salary or earnings from that employer is more than $145,000, your catch-up contributions must be Roth contributions. That's a change. So your catch-up contributions have to be after-tax contributions. Another change, student loan payments can be treated as elected deferrals. What that means is if, let's say, a younger worker who is making student loan payments, there's a mechanism for that to be qualified as an elective deferral, meaning that the employer can match into the 401k based upon student loan payments. And then there are additional catch-up contributions built in for ages 60 to 63, but that doesn't start for a few years, okay? And at the time, we can cover all that. But there's some added catch-up contributions allowed. All right, next. What is also notable were some things that were not in the Secure Act 2.0. So most of you may or may not be familiar with a concept that we call the backdoor Roth. All that simply means is a high income earner who is unable to contribute to a Roth IRA because they have too much income. There's a way to actually make a non-deductible contribution to a traditional IRA and immediately convert that to a Roth. And we do that for a lot of you. There was a lot of speculation because, again, that's kind of a circumvent around the rule to allow a high income earner to be able to get money into a Roth IRA. And so a lot of people figured that with the new legislation, they'd finally cut that out because when it was an unintended circumvention of the rule. It wasn't cut out. And so what it does is it kind of validates that absolutely is a strategy. And it also leads me to believe that, I don't know, they may become more lenient on the income caps in the future. Who really knows? They also, in the Secure Act 2.0, did not limit who can make Roth conversions, okay? Which, that's an important distinction. Previously, there was a cap on income to be able to do a Roth conversion. They removed that, and that has stayed. So now anybody, regardless of income, can do a Roth conversion. They also did not eliminate what's called the Mega Roth 401k. And I won't go into what that actually is, but basically it's a way for people to put a lot of money into their Roth 401k using after-tax contributions above the elected deferral amount and then do an immediate conversion to a Roth. I thought that was interesting, actually, because there was a lot of scuttlebutt about that probably being disallowed. but it wasn't. And then, unfortunately, they did not clarify some of the ambiguity around the 10-year distribution rule for IRA beneficiaries. And I'm not going to go into what the ambiguity is. Just understand, again, if you're in that situation, we can talk about it and I'll explain it. But that was not clarified either. Now, this has gotten a little bit of publicity, and you may have heard of it. This, I think, I had not heard that this was even something on the table, and it just popped out of thin air, in my opinion. But starting in 2024, there's an allowance now to be able to move 529 contributions and monies, essentially transferring, rolling them into a Roth IRA. So here's what we know about how that works. Now, there's some unknowns still, but here's how it has to work. If you have 529 money, it must be moved directly from a 529 to a Roth IRA. The receiving Roth IRA has to be in the name of the 529 beneficiary. So, example, let's say your son, all right, my son, Carter. We have a 529 for Carter. Let's say he doesn't go to college or goes to the military or gets a full ride or whatever it might be, and there's leftover money in his 529 plan. This now allows 529 funds to be rolled over to a Roth IRA for Carter. So it has to be in the name of the beneficiary. That beneficiary must have compensation. So, and it falls under the Roth contribution rules. So in other words, the effect that they're trying to have is allowing you money that may have not have been used and kind of stuck, for lack of a better word, in your 529 plan for your kid, using that to fund a Roth IRA in their name. That's the intent behind it. The 529 plan has to have been maintained for 15 years or longer. That's a unique rule. They're trying to prevent kind of the backdoor Roth strategy where you just contribute to a 529 and move it. Got to be in there for 15 years. And any contributions and the earnings attributable to those contributions within the last 5 years, they're ineligible. All right. Now, one of the questions that has come up, and this is where we don't know yet. Again, I think over time we'll get some clarity. Many people are aware that you can change the beneficiary of a 529 plan as long as it's within the same family, right? So my son Carter, I could change the beneficiary of his 529 to his brother, okay? I could also change the beneficiary back to me. So what people are wondering is what rules are going to be specified about changing the beneficiary and funding, maybe kind of skirting some of the rules. Again, we don't know any of that yet. But I do think this is a pretty cool, again, the intent, because we've had conversations with some of you about, well, what if you overfund to 529 and your kid gets a full ride? This allows for a way out. Now, it also, I don't think I wrote it here, but it also is capped at a total of $35,000 of lifetime rollovers from the 529 to the Roth. So it's not like this can be, hundreds of thousands of dollars, but it isn't a unique feature, I thought. So that was a lot, but let's break it down into a timeline. Okay, so what you need to know now, and then what's kind of in the future. Here's what you need to know for 2023. The required minimum distribution age is now 73. I didn't mention this yet, but they have reduced the penalty for missing a required distribution. So let's say I was supposed to take $10,000 out of my IRA this year, and I forgot or I didn't do it. Used to be there was a 50% excise tax on a distribution that was not made. It is now reduced to 25%, so a little more palatable. The other 2023, Roth employer matching contributions are permitted, as we discussed. So if I'm contributing to a Roth, I can have my employer contribute their matching to the Roth. Again, if they allow it. One thing to note, those matching contributions, because they're Roth now, they're going to be taxable to you, whereas the pre-tax is not. And it's only going to be useful or allowed in vested matches, right? So if you don't have fully vested matches in your 401k, you're not going to be able to contribute all of those matches to the Roth. One other thing in 2023, it created, some of you might be familiar with the SEP IRA or a simple IRA designed for small employers. They're retirement plans like a 401k, but they're small employer plans. It now allows for Roth contributions to be made into those vehicles. So those are some of the main ones in 2023. 2024, that's when employers earning over $145,000 that are making catch-up contributions, that your Roth, they must be Roth catch-up contributions. 2024 is when the 529 to Roth strategy becomes available. And 2024 is when the student loan payments to be treated as elective deferrals are allowed. And then 2025, that's when some of those additional retirement catch-up contributions for ages 60 to 63 are allowed. A couple quick future updates. And look, I'm gonna be right at 45 minutes, I think. A couple quick future updates. There's a lot of dates that are all over the place. There's going to have to be some clarity that comes out through either IRS rulings or whatever it might be around some of these dates and strategies and such. We'll continue to provide information. Again, as we do meetings and strategy sessions with you, we're evaluating what of these makes sense, should we make changes, etc. So that's important for you to know. The other future update, again, we're getting closer and closer to the end of the Tax Cut and Job Act. Okay, that was back in 2016. That was the tax laws passed in 2016 that lowered a lot of the rates. I mean, it really changed a lot about the tax code. That was a 10-year period. That all goes away starting January 1st of 2026. And again, unless Congress makes some sort of changes, which is possible, who knows? But if not, we're going to have higher tax rates. They're going to be much more unfavorable. The standard deduction goes way down again. And then the estate tax exemption goes way down again. So those are some things that they're really on in our sights as we try to plan, okay, because we're in a pretty good, relatively speaking, tax code at the moment. And so that goes into a lot of our decision making as well. All right, that's all I've got. Hopefully that gives you a little understanding of some of the Secure Act laws. Try to boil it down into simple terms. You read stuff online and it really is all over the place, and they talk about stuff that's really confusing. Hopefully that gives you a sense of what might be most applicable to you. And then this market this year, we'll see how it all goes, but I do think it's likely to be a much more constructive year, and I hope that gives you a little bit of sense of confidence, particularly as we go forward. So as always, thank you. We appreciate you. Hope you enjoyed the session, and look forward to seeing you again in the future. Thanks. Bye.